Hello, everyone. Welcome back to Financial News in Peerless Heights. Today is February 13th, 2023. Paul Municle is my cohort and giving you all the information that we can about what took place last week and in the past. Paul is with Ameriprise, and they have been very helpful in giving us a lot of resources of information that I'm going to share with you what is taking place as of this morning after Paul gives us an update. And Paul, I'm going to let you take it.
Thanks, Ron. Through Friday, February 10th, we have about 350 of the S&P 500 companies, or about 70% of the index. They had released their Q4 financial results. Now, in the coming week, 61 S&P 500 members are on the docket, including 2 that are also members of the Dow Jones Industrial Average. Now, to this point in the earnings season, earnings per share, otherwise known as EPS, results have been broadly weaker than expected on aggregate basis, while sales growth has been somewhat stronger. Now, over the last week, however, the EPS growth estimate for the index improved somewhat. Now, FactSet's blended earnings per share estimate, and that combines actuals and estimates to get the number, now looks for Q4 S&P 500 aggregate EPS to have declined by 5% year over year in Q4 versus the 5.5% year-over-year decline estimate for the period as of last week. Now, a 4.3% decline was forecast at the start of the release season. Sales growth, meanwhile, is currently pegged at a positive 4.7% year-over-year, up from last week's projected 4.3%, and the 3.8% forecast at the start of the season. Now again, according to FactSet, aggregate sales growth would be positive 5% year over year, with the utility sectors alone excluded. Forward earnings estimates have been under considerable pressure since the current release season began. S&P 500 EPS estimates for the full year 2023, of course, are now forecast to be a sharp $6.93 lower than their level of January 2nd, which was $222.54 currently versus the $229.47 previously. Meanwhile, full year estimates for 2024, they're down $3.99 since the year began. Overall, however, both full-year estimates still look for year-over-year growth of 1.3% and 12.1% respectively. And we do have additional data to back the information we're going through today. So should you want to see more information on it, feel free to reach out to me and we'll get that out to you guys.
Okay, and as I had mentioned earlier, Ameriprise had forwarded this information as of this morning. U.S. stock index futures are mostly higher after losing 1% last week. Markets in Asia closed mostly lower, led by Japan down 1%. Europe is trading broadly higher at midday. Treasury yields are higher at the short end, with the 2-year at 4.55% up, while the 10-year is steadily at 3.74%. Bitcoin futures are down 0.3%. Gold is down 0.1% after losing a 0.2% last week, and WTI crude is flat after gaining more than 8.5% last week. Well, that's what's causing some price changes and increases at the pump, I'm sure. Anything you want to add, Paul, or is this...
No, I'm kind of anxious for you to report the year-to-date numbers because all of last year they were so bad. It's nice to hear what you're about to say.
Year-to-date index futures, index returns are as follows. S&P 500, a plus 6.7%. Dow Jones, a plus 2.3%. NASDAQ, a plus 11.9%. That's a real switch from what we were reporting several weeks ago.
Yeah, I mean, of course, you were here with me every week last year. Every show last year,
Minus.
those negatives, those indexes were minus, 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 and pretty steeply in the minus. We got a long way to go to make up what was lost from last year in these indexes, but so far, based on the numbers you
right track.
reported, we're on the right track.
Yep. Yeah. Okay, thank you, Paul, for bringing that to us. Stay with us. We are going to be right back with our show called Your Money. Paul usually has a very interesting topic. We'll see you in a moment. Thank you for staying with us. We are with our new show called Your Money. And Paul's going to talk about your investments for 2023. Paul, take it away.
Thanks, Ron. You know, investors came off of a difficult year, as Ron and I just talked about, in 2022. Stocks fell into a bear market, and that's defined as a decline of 20% or more from peak highs. And the bond market lost significant ground as well. Now, the stunning jump in inflation after years of very low interest rates made matters even worse. Watching your investments and the value of the dollar depreciate simultaneously, I know it wasn't easy. And the prospect of more volatility ahead, as many investors are nervous. Now, as a financial advisor, I've fielded many questions over the years from clients and prospects alike, and you at home may also be contemplating those same questions. So I'm going to go through a few of the things I often get after a year like last year. Now, keep in mind that while there is no single solution that applies to all investors, there's some general guidelines that you should consider, based on where the markets stand today and the historical record that may be helpful. And again, these guidelines may not apply to you specifically, but they're just general guidelines to consider if they would help with your investments. So one question I always get is, how should I cope with the market fluctuations that are affecting my retirement savings? And I usually tell people, if you're within 5 years of your retirement date or already retired, be aware that you have less time to make up for losses in your portfolio. You may want to reevaluate your risk tolerance projected, your income needs, and your investment strategies. It may make some sense to pursue multiple strategies, seeking to grow a portion of your nest egg while protecting dollars that you will need to tap into more immediately, the next 3 to 5 years. If you are more than 5 years away from retirement, focus on mitigating risk in your portfolio with high-quality investments and income-producing securities. If you have available cash to invest, consider doing so using a systematic approach, which is investing a portion monthly, maybe over the next 6 to 12 months. By dollar cost averaging in this way, you may be able to offset some of the market's inherent unpredictability. And if retirement is longer term, 10 years or more away, maybe think about working on growing your nest egg. Time's still on your side with more than 10 years. And view the market's recent downturn as a potential opportunity to position your money in quality assets that are available at more attractive prices. Now, although markets will experience downturns from time to time, keep in mind that over rolling 10-year periods, the broad stock market, as measured by the S&P 500 and index, has tended to always move higher. No guarantees. Past performance, of course, is no guarantees of future results, but something to consider of saving for your retirement. Another question I always get is, what should I do if I have not yet invested or am fairly new to it? I like to tell people, if you're new to investing, chances are you have a long time horizon before retirement and can potentially ride out short-term bumps in the market like last year before you'll need to start withdrawing assets. Start by finding ways to save even small sums of money on a regular basis. This can include contributing to your workplace retirement plan, such as your 401k or 403b, and putting money to work monthly in a traditional or a Roth IRA. The sooner you start investing, the better your opportunities can be to accumulate wealth. Next question, common question is, I'm very comfortable with markets and volatility these days, so how can I overcome, excuse me, I misspoke there. I'm very uncomfortable. I'm comfortable with it, but the question I get is, I'm very uncomfortable with markets and volatility these days. What are some things I can do to overcome that? And I tell people, while you may wonder whether you should invest or continue to quote unquote ride out the challenging market, it's important to stay invested. You'll want to be positioned for a recovery which typically occurs without warning. Keep in mind that in the first year after the low point of the last 9 bear markets, the S&P 500 returned an average of nearly 50%. A good place to start is to speak with your financial advisor, who may be able to help you steady the boat, and your advisor can help make sure that your portfolio is positioned to meet your key financial goals and is consistent with your potential or your risk tolerance level. And remember, again, past history, there's no guarantee at all that that's how it's going to go down this time. That was just some things that happened last time after a bear market. The keys here are to do what's right for you. These are just some general questions and some general answers, but generalities do not apply to you. You need specific answers to your investment style. Maybe you're extremely conservative. Maybe you're aggressive. Maybe you're somewhere in the middle. These are all things you need to figure out or discuss with your advisor to get the appropriate investment mix for your risk tolerance and to meet your investment goals.
Paul, with the unpredictability of the market anymore today, with market bumps, inflation, it's so important that you or the viewers, if they're not sure of what they're doing, they need to talk to a financial advisor. And if you're willing to take additional questions, other over and above what you just mentioned, can they call you?
Absolutely. And the one thing I do like to predict to people is I often predict that the market will be unpredictable.
Yeah, for sure.
It's going to happen. We're going to have years like last year. We're going to have years like a few years ago that were strongly positive. There's no, we're going to have up years and down years. You can count on that. And getting through those down years without making mistakes is very important with your portfolio. And as I mentioned, making sure you're aligned with your risk tolerances, so you're not taking on too much risk for what you're comfortable with. But sometimes it's what your needs are. Some people need to grow their money more than others, and they need to take on more risk. But like you'd said, that's something you have to talk to an advisor about to determine that. So
your personal projections and your needs, all built that in to your questions to your financial advisor, and let them look at the entire portfolio as to what things should be adjusted to maintain whatever your needs are.
Exactly. And if you're at home working with an advisor, that's great. If you're looking for a second opinion, or you're not working with someone, especially after a year like last year, you can feel free to give me a call directly at 708-226-3412.
Okay, thank you, Paul. And for Paul Munichlo with Ameriprise Financial, myself, Ron Jankowski with Channel 4, we wish you good investment day.